Pat says, hey Denzel, I know you are using a first lien HELOC to fund your IBC policy, but I was wondering if you ever stack whole life policies where the cash value pays for the premiums of another policy, question mark. Pat, the answer is no. From the life insurance agent's point of view, right? And I know this is a strategy, right? Like what they call it stacking. Now, in the life insurance space, guys, like we got to be careful. I think the word is called churning or twisting, I forget. But essentially, it is frowned upon to, as a licensed agent, to encourage you as a customer to buy one policy for the purpose of taking the cash value out of that policy to fund another one, and then take the cash value out of there to fund another one, and kind of create a system of you're funding that initial policy, and then you borrow out of here to start this, borrow out of here to start this. You'll have 3 loans going at the same time. And when you use a whole life insurance contract, your most expensive years are in the front years. So what could happen with that strategy is you're injecting unnecessary amounts of risk, Pat, in my opinion, if you were to do that. If you are doing that, the way that I've seen it work is when the user is a life insurance agent. So they're collecting the commission on their own policy and then dumping that commission in the policy to cover the initial cost of starting that. Does that make sense? Right? So this is what it would kind of look like is, say you put 50K into policy number 1 and you design it for max cash minimum base, right? First of all, the life insurance companies frown upon this. Through training, they frown upon this. Like everybody, this is not okay, right? This could lose, someone could lose their license if they're actively preaching and teaching about doing this, right? Because they're just forgetting the risk part. You're injecting unnecessary amounts of risk. But I still want to map it out to show you what it could potentially look like. So 50K a year assumes the person has 50K to work with every single year, right? And then they borrow out of this one and they fund policy number 2. Maybe they put that on their wife, right? So this is husband, and they borrow from here to fund their wife's policy, boom. And maybe they borrow 25,000, right? Same thing, max cash minimum base. Then they borrow out of wife's policy to fund policy number 3 on their son, 21 years old, and they did 10K. So you'd have a loan for 25,000 at, let's say, 5.5%, and you'd have a 10K loan here for, say, 5.5%, and then no loan on this, because eventually you got to stop, right? You want to just keep doing it because you got to stop, because then you'll crush the strategy, essentially. So that's what that looks like. Loan, but one $50,000 policy funded 3 policies. Here's what I would say, right? That is safer to do is just split the 50 up. So maybe on dad, we put 25K, and on mom, we did 10,000, okay? And then 15 on son or something like that. Just boom, boom, and boom. So I think that's more efficient because you're not taking any loans whatsoever, so you're not creating new expense, right, in this. And it's honestly safer because you're setting a lower expectation. Because technically what happened here, what actually happened? Well, they took 50K and they turned 50 into 75 and then 75 into 85,000. That's what they did here, right? Do you see that? Like 50K went in here. They took 25 out, but understand that when you borrow against a life insurance policy, your cash value still remained in there as if you didn't touch it. So that money's gonna grow, right? And then you got this 25K and now you got 75,000 total life insurance premium, right? That you created out of debt. And then you borrowed from the 25, you took 10. So you have $85,000 in premium technically, as opposed to $50,000 in premium. The only way this works is if you continue to have $50,000 every year plus the cost of interest to carry the loans, right? So let's do that. 25,000 times 5.5% is 1,375. So that's your cost on 25K for the year. And then 10,000 at 5.5% is $550 for the year. So this person in the next year would need to have 50K plus 1,375 plus 550. So in year 2, in order for this to work, right? Year 2, you're gonna need 51,925. And then year 2, you do it again. You do another loan for 25K. So now you have 50K in loans at say 5.5%. So now you're at 2,070 year 2, and now you got 20,000 in loans on this one at 5.5%. So now that's $1,100 in year 2. Okay, and then you do 1,100 plus 2,750 plus 50 grand. So in year 3, right? Year 2, you need 51,925. Year 3, you need $53,850. So this only works, this stacking whole life policy thing, if you know when to stop stacking. Number 1, that's key. You got to know when to stop, right? 2, you need to keep putting more money through the system to cover the loan interest costs each year. That's important. And understand that your income needs to keep going up, or cash flow needs to keep increasing to support the increasing cost of what you're creating inside the policy. Because by the time you get to year 3, look how much you have in loans. You got 30 grand in loans over here. You got 75,000 in loans over here. So you got 30 grand plus 75 grand. So you created $105,000 in loans in 1 year. But what is the advantage here? Well, the advantage is you did start 3 policies using just 50K, but technically created yourself $85,000 of total premium instead of just 50, right? So again, this is frowned upon in the industry. Life insurance companies do not like this. They don't promote this. They even ask you when you're funding a life insurance policy in the application, they want to know how many policies you already have in place. And if you're using funds from the cash value to fund the new policy, you have to lie to the insurance company and say, no, I am not. And then they're going to ask you, where are the source of funds coming from to fund 3 policies in this span of time? So you have to lie in order to do the strategy. Your agent has to know what you're doing, and he or she has to lie for you on behalf of the insurance company, on behalf of the insurance agency that they work for. So everybody's lying, right? So you have that risk there. Can this be done? Yes. Why? Because it's been done before. People are doing this. Obviously, Pat knows about it, right? And many others know about it as well. And to the consumer, it seems like a really cool freaking strategy, right? You see the way I just mapped it out? Like, it actually sounds kind of cool. I just turned 50 grand into 85 grand. 85 grand is now growing. Now, obviously, not all of that 85 grand is growing in cash value, but over time it will. Right? Over time, that money grows, right? So it's really interesting how a lot of our minds work sometimes. And again, like, remember how I said earlier, I don't call anybody stupid or call you ignorant or make you feel any less if you have a question, right? So notice how I didn't throw Pat down and like tell him he's crazy or anyone's wild. I actually ran through it, right? I ran through the numbers, showed it to him, had him really think on it and say, yeah, you know what? I'll still do that, right? Because I have to be careful what I'm saying, because like I'm a licensed insurance agent, but there is a term that is used when you're actually getting your life license that actually frowns upon doing this. And I don't know if it can result in the agent losing their license. I don't know if that is the penalty, But what I do know is that it's frowned upon. The insurance companies don't want you doing this. When you're applying for life insurance, the insurance company wants to know where the source of funds are coming from to pay for this life insurance policy. Because the other thing that this could look like is money laundering, right? This could also look like money laundering. So you have to also think like, holy crap, am I thinking like a criminal, right? Because because you have to understand, like, there's certain people out there in the world that are really, really like smart, and they think how they can finesse the system. And once it gets caught on enough times, eventually they create regulations and laws to prevent people from doing that. But these would all be red flags of, I think the word is churning or maybe stacking, and also red flags of money laundering, because you're basically cleaning the money, right? You take that 50K, you buy a policy, you insure another human being with the life insurance, you insure another human being. So a simple family of 3 could do this, right? But again, like, you're injecting kind of more risk, and it sounds really cool because you took 50 grand and you turned it into $85,000 of premium, but without having to come out of pocket 85 grand. It would take like 10 years before you're actually coming out of pocket 85 grand to fund these policies, right? But the problem here is eventually, Pat, you would have to stop like the churning. You'd have to stop eventually because the loans would get too heavy. They get too big inside of the policy. So what you would need to do at some point is you'd have to get your income and cash flow high enough where you're no longer like funding all those policies like max funding. So maybe you do short funded periods, like 5-7 years, let's say, but you don't want to do it forever without increasing your income dramatically over time. Because, as I showed, 51,925 the second year, then you need 53, then it goes to like 56, and it starts to really stack. Over time, it can get a little scary. Pat says, thanks, Denzel. Appreciate it. Didn't know if you had to justify what the cash value loan would be used for. Love the content. Yes, so you do have to like lie to the insurance company. And I don't know what the ramifications would be on that, but I do know you can essentially tell like a little fib, kind of get away with it. And you also would need to space it out. Right? So you have to fund the first policy, wait a few months, take a loan out, let that money sit, season in a checking account. Then you fund the policy on wife, let it settle, a few more months, do another loan. You have to space that kind of stuff out. If you do it too short, the insurance company is going to, boop, red flag. They're going to think you're doing money laundering. It's going to look kind of crazy, right? So now there are legitimate scenarios. Like I had a case where I had a client funding $70,000 a year into his policy, like $30,000 into his wife, $3,600 into his daughter. 1 year he was a little low on cash value, a little low on funding, total funding. So he put 70 grand into his, and he did borrow some of that, but not till like, I think it was like the second or third year. He borrowed from that to fund his wife's policy so that would stay up to date. So there's times where you can do that, where you did borrow from one to basically pay for the premiums of an existing policy. That's not illegal. You're allowed to do that. It's just not something I'm out here like preaching to my clients to go ahead and do. It's more of like a fail-safe, a protection for the sake of max funding and keeping the policies healthy and enforced. You can easily borrow from here to get this other one funded and give you the time to make up for the money that you were intending to pay for, right? So the great question, Pat. I think it was really good. I was just thinking, until you get to the efficiency point in the policy for the first few years. Yeah, so the only way you get to the efficiency point is by making more money, and then having a plan to start to like knock down the policy loan debt, or you're only max funding for like 3 years, 3-4 years, something like that. And then you reduce the funding and you start splitting funding and payback of loans. That's how that would end up working out. So, yep, thanks a lot. Awesome.